Good evening, ladies and gentlemen, and welcome to our conference call this afternoon. I am Trevor Wilde, CEO and Managing Director of Wilde Wealth Management Group, and I want to welcome you all to the call tonight. I thought what I would do here just real quickly, for those of you who have never attended a call like this before, just kind of walk through the purpose of tonight's call and a little bit of why we're on this call tonight. I probably don't need to walk or even tell you, right? 7 days ago, we saw Russia invade Ukraine, and a lot of things have occurred that we wanted just to address. We have three primary focuses on the call tonight. Our first is really to talk about, the Russia-Ukraine situation and what's changing there, and it certainly is a progression every single day, as you guys have all followed and watched for the last 7 days. It's certainly a moving target, but we do want to hit on some of those key things that we're watching. We would like to talk or just touch on monetary policy, right? There's been discussion all year about interest rates and inflation, and again, another moving target as information has been coming all week we want to talk about. And in general, just open it up to talk about some of the things that we're looking at and to give you insight as to what we're doing and how we're looking at things. I'm looking at some of the names on the call list today, and a lot of you have been clients for 20 years or longer, and so these types of calls are probably not too foreign to you. But as a firm, one of the things that we've always done is communicate. We host a quarterly conference call, economic call, at the beginning of each quarter. Jason File, one of our advisors here in Scottsdale, hosted our January call with Gene Goldman, the CIO of Cetera Financial Group. And some of those themes even play into tonight that we're going to touch on. The last time we did one of these calls that was outside of the normal quarterly market update call was March of 2020. And a lot of you were on that call. We've got to take you back, 2 years to what was going on in March of 2020. But we did that call at the end of, the second week of March. The stock market had gone down 42%. The major markets were down somewhere between 35 and 40%, and the world had shut down. And it's interesting, as we prepared for this call tonight, some of the same things that we were talking about then, we're going to be talking about tonight briefly. I also think, I've been doing this for 21 years now, and the markets, we've had periods of uncertainty, we've had periods of war, all these different things, and we're seeing a lot of them right now. And I do think there's two other goals that we have tonight. Number one, I want to bring some historical context into play. It's very easy, I think, for individuals and even us as advisors in making decisions and managing money to become emotional. It's hard not to become emotional when you look at the human tragedy that's happening in Ukraine and the heartbreak that's occurring. But I am going to bring some historical perspective to what's happened, at least historically, how the markets have reacted to past, what we're going to call major geopolitical shocks, basically wars that have occurred over the years. And I think it'll be interesting, and some of you might remember even some of these events that have occurred in the 70s and beyond. So our goal tonight is that. I also want to encourage each of you out there, if you are having concerns, if you're losing sleep at night, we want to hear from you. Our perspective in doing this for 22 years and longer for some of our advisors, our CIO, Doug, has been in the industry since the 1970s in one way or another, managing money, being an advisor. But we do want to hear from you. We want to make sure that we're thinking about things and managing risk the appropriate way, and that is different for everybody on this call. Right? We serve people that are well into their retirement and those that are still 25 years away from retirement, and everybody has different feelings and opinions on risk and reward. And I want to encourage you that if you're having uncomfortable feelings or just need an ear to talk to, you need reassurance, please reach out to us. Our advisors are here to help. They're working very hard to make sure we're making good decisions and doing that on your behalf. I also thought I would take just a quick minute to touch on a few items that are upcoming. We've put a lot of efforts into educational events to continue to educate you and the people you care about. We've got a couple that are coming up. At the end of this month, March, our webinar focus this month is Roth IRAs. And we're going to be hosting a webinar on March 30th at 12 noon Arizona time and 6 p.m. And in April, our focus for our webinar Wednesday in April is going to be estate planning. And those webinars in April will be held on April 27th at 12 p.m. Arizona time and 6 p.m. Arizona time, again on April 27th. And our focus for Q2 from a charitable perspective is a really amazing organization called Child Crisis Arizona. Just wanted to tell you to keep your eyes open for some of those invitations as they're coming, and ways to get involved in the charitable focus for Q2 with Child Crisis Arizona. So that will be forthcoming. So we're going to get to the meat and potatoes, and I have to say, many of you that have been around the firm for a long time know, my father actually started our firm and started in the industry about 35 years ago, and it's seldom that I see him in the office now, but he's here with me tonight. So I wanted to introduce, for those of you who know him and for those of you who don't, my father, my mentor, my longtime partner, Bill Wilde, is here with us and is going to be sharing some of his thoughts on what we're seeing play out over in Europe today, and some historical perspectives and some important things that we think we need to be thinking about. So, Dad, would you like to say hello?
Hey, how's it doing? How's it going, everybody? Trevor called me out and says, hey, we're having a meeting tonight, and I had to come in off the golf course, but I do come in every Thursday for sure. We have an investment committee meeting every Thursday afternoon at 2:30, and that's always interesting. So Trevor's got some slides here that he wants to talk about that he's worked on, and then after he finishes, if there's any time left, he said I could speak to you about what we see going on today.
Well, I appreciate you being here, Dad. Thanks for popping in and dragging yourself off the golf course. So what I thought I would start with is a little bit of historical standards. So one of the things that we wanted to talk about today and that we looked at was, again, what we're calling global major geopolitical shocks that have occurred historically, and how the markets reacted. And I'm going to go through a handful of them. And if any of you on the call would like to see this information, please reach out to us. My direct email is trevor@wildewealth.com, or you can call the office and we can get you some of these details. But what we looked at, and these are big events, and I'm going to go to the worst event that's on this list, and that was the attack of Pearl Harbor. December 7th, 1941. Everybody knows what happened. The attack of Pearl Harbor occurred. What's interesting, and what I was surprised to see when we pulled these numbers, is how the market responded. So on that day, December 7th, the stock market was down 4.15% that day. And it got worse. As you know, with Pearl Harbor, we went into a prolonged war. 140 days later, the stock market went from being down 4 to being down 20.34% in that period of time. And it took the markets 304 days from the day of the event to fully recover. In fact, if you looked out a year later, not only did the stock market fully recover from that one-day return of being down 4, but it actually, like I said, it drifted. And at day 140, the stock markets were down 20%. But by the end of that year, it had rallied, and the stock market was actually up 3.7%. And there's about 15 different periods on this. That was the worst. The second worst period, looking historically, was Iraq's invasion of Kuwait. That happened August 2nd of 1990. The stock market that day was down 1.19%. The worst it got was 71 days after the offensive began, and the markets were down 17.47. And it took 6 months, roughly 6 months, to fully recover. And 1 year after the event in 1990, the stock market was actually up 13.66%. The Cuban Missile Crisis, which I remember, my mom grew up in Pensacola, Florida, and as a kid and even as an adult, I remember my mom talking about these days in the 60s, and they had a bomb shelter. And I remember Mom talking about when she was a kid in high school, they would have these bomb drills, and it's unfathomable really to think about growing up in the day and age that we have the last 20 years, because we just have not had to worry about that. But October 16th, the Cuban Missile Crisis occurred. That's October 16th, 1962. Stock markets were down 0.31% that day. 8 days later, they hit their worst point in that conflict and were down 6.68. A year later, the stock markets were up 30.91%. More recently, the U.S. terrorist attack, 9/11. On 9/11, the day that happened, the stock market was down 5%. The max drawdown during that period of time took about 11 days, and the market was down another 11.89, and took 30 days to fully recover from that event. Now, when you look at 2011, the other thing that occurred we had the terrorist attacks, but we also fell into recession shortly after. So there was a prolonged period there from 2000 to 2001 where the markets were down, through that whole period. North Korea invades South Korea, June 25th of 1950. The stock market was down 5.27%. The worst period of time during that period was 19 days later. The markets were down 12.16. And a year later, the stock market was up 20.3. What I found really interesting about, 7 days outside of this event, Russia invades Kuwait, February 24th of 2022, and 1 day later, and this is the only time in all of the periods that we found historically where the stock market was actually up. So the day after the invasion, the stock market was actually up 1.5% that day, which is unique, right? We look back at all these historical periods of time in the stock market, every single one of the other periods, all the way back to Pearl Harbor, the Tet Offensive, the Six-Day War, the Boston Marathon bombing, all these events, the stock market was down pretty significantly in that day. And what I find a little bit interesting when you take a step back and think about the events that have occurred, what this doesn't say is what the markets were doing right before. And this event is unique in the fact that what happened is, Putin lined up tanks on the border of Ukraine 2 weeks before the event occurred. And specifically, the prior 5 trading days leading into last Thursday, the markets were actually down about 6%. And we had leaders from around the world, including our leaders here, telling us that this wasn't a question of if, this is a question of when. And a bit unique because, again, historically you would see the event happen and then the markets decline. What we've seen so far in this event was the markets declined in advance of the event occurred, and we actually saw a rally. So just a little bit of historical perspective that we think is important, and not one of these periods, actually there was one out of the 15 periods of time that we looked at where the markets were down a year later. The average return, when you look at all the historical periods a year later, was up somewhere around 15%, at least historically. So I hope that helps. It doesn't mean that this will be the same, but what we find is, looking historically for at least ideas of what could happen is important, and we think this will probably play out to be the same. A couple other thoughts I had, and Dad, feel free to step in here if you have any other thoughts that you'd like to interject. But there's some unique things that have occurred here in the last 7 days that I thought would be valuable to touch on. We've obviously seen sanctions from around the world, and one of the first things that we started to hear about was the SWIFT banking system. And I've had a handful of clients reach out and say, hey, what's this SWIFT and why do we care about it? SWIFT actually stands for the Society of Worldwide Interbanking Financial Telecommunications. And the best way I would explain this, or that I've heard explained, is if you're familiar with Venmo and Instant Messenger, it's kind of a combination of the two, where international banks between boundaries were able to communicate financial details immediately, securely, and very, very quickly in order to be buying assets from each other. And that was the first thing that we started to hear about last Friday was sanctions around SWIFT and some of the banks that are in Russia and have already been sanctioned. And that's already occurred. We've seen sanctions around a lot of Russian entities, but one of the points that I wanted to make, and I think that this is important to understand, is that there will be repercussions, right? I mean, one of the things that Russia, one of the biggest assets that Russia has is energy. 10% of the global oil supply has come from Russia. And maybe even more important to Europe, the natural gas output that is used by Europe, 40% of the natural gas that's used in Europe comes from Russia, or at least has historically. And so, as much as we would like to disconnect potentially from these things, it's going to be very difficult to do, and there will be some pain. And we've seen oil, I don't know, did you see the closing price today? 112, I think is where it closed at. We've seen the price of oil spike dramatically, and we're going to see 109, and fuel prices are heading up, so we're going to see that. One other thing that's also been impacted, and I think this was even before the offensive occurred, the other things that were going on in the U.S. economy that were becoming worrisome were inflation and interest rates. And we've been hearing about inflation for the last year and the problems that have been happening with supply chain. We've gotten those numbers from 2021, and CPI came out of last year somewhere around 7 and 7.25%. And one of the things that we've heard leading into the crisis, going back a couple weeks, was what the Federal Reserve was going to do to try to help combat inflation. And most of the polls that were out there 2.5, 3 weeks ago had the Federal Reserve raising interest rates maybe as much as 50 to 100 basis points. That's 0.5%, to maybe a full percent this month in March. Dad, maybe you can talk a little bit about, in interest rates and inflation and what's changed since last Thursday with the Federal Reserve's approach to interest rates.
Well, the headlines really has been relating to the markets, have been focusing on the S&P 500, the NASDAQ, the Dow. But the reality is, one of the things that we look at more than we do stock market fluctuation is what's happening with the bond market. Today, the yield on the 10-year Treasury closed at 1.84%. That's down, actually. It got to be as high as 2.065% earlier this year. So if the bond market is not showing any signs of really any signs of fear as it relates to what's happening in Russia. There have been more buying of bonds because the U.S. Treasury is still considered to be the #1 place for security and liquidity worldwide over any other market in the world. And so, just as perspective, the European or the Russian Central Bank have raised their interest rates to 20% because they're trying to stop a run on the Russian banks. And currency is trying, all foreign money is really trying to get out of Russia right now, and it's really put the Russians in a bad way, the Russian consumer. But the bond market is really pretty calm about this whole situation, and that is the indicator we like to look at, is what's happening with the yield on the 10-year Treasury, which still is very, very historically low. The other thing that I think is really important to have some perspective on is last Friday, the consumer confidence reading came in at 110.5. So back in February of 2009, right at almost the bottom of the market that we saw during what we call the great crisis, financial crisis that we saw what happened to real estate. The consumer confidence reading in February of 2009 was 27.5. The reason this is important is because, as you know, that 70% of the U.S. economy is driven by consumer spending. The consumer, partly because the government's giving everybody money, the consumer is in good shape, partly because of the pandemic. A lot of people have stayed home, and there's still a lot of fear that we see with a lot of people who still don't have much of an appetite to travel, to get out and be in crowds. But the consumer confidence ratings today are very good. The other thing I think that's really important to understand is, the productivity ratings. Productivity in the fourth quarter rose by 6.6%. Wages are up 7.5%, but because productivity was so good in the fourth quarter, that the real cost to corporations was minimal. It was less than 1% because of the, how good productivity was. So what we're seeing here with Russia is it's gonna cost Russia dearly. I think the reality that Mitt Romney forecast back in the election cycle with Obama was that Russia was a problem, and everybody, basically the New York Times said, just to give you perspective, it said about Romney, he said, well, Romney's been getting his foreign relations training from the International House of Pancakes. And so they really didn't believe what he said about Russia. But we can see that Russia's a problem, and probably will be for the foreseeable future, just because of the mentality of Putin trying to reassemble the Soviet Union prior to the dismantling of the Iron Curtain, basically. So the economic news is really quite good. There's still 11 million jobs that are unfilled in this country, and corporations are having to pay more money to get people to come to work. And that in a bad economy, if we were seeing these things going into a bad U.S. economy, but we're not. The unemployment rate is still extremely low. It's less than 4%, the national unemployment rate. So from an economic standpoint, the basic U.S. economy is really running pretty hot, as we can see by these inflation numbers that we've been hearing about, because of the the inflation rate that they're saying is still running hotter than they want it to be. So from a pure economic standpoint, U.S. economy is in really quite good shape. The other thing is, year to date, okay, as of today, the S&P 500 is down 9.4%. Last year, we saw 1 month in the whole year where we saw much volatility. And that was in September of last year. The S&P 500 came down in the month of September about 6.5%. And that's not common. What we normally see is not uncommon to see a 10% drop in the markets. So the headwinds that we've been seeing now, this skirmish or the invasion that we're seeing over in Ukraine has caught the attention, and it does create some uncertainty as it relates to that part of the world. But the reality is that, for the most part, the developed economies worldwide are in pretty good shape financially. So we think that by the end of the year, the U.S. economy or the market will be higher than it was at the beginning of the year. Going back to 1980, 70% of the time when the markets are down during the year, 70% of the time, by the time the year ends, they finish in positive territory. So that's a little bit of historic numbers to give you something to chew on, other than just focusing on the war itself.
Yeah, and I think a couple other things just to add there as it pertains to market corrections. And some of you that maybe were on listen to the forecast call that Jason hosted earlier this year with Gene talked about, one of the things that he talked about was a higher chance of volatility. And part of what he connected on, and part of what we had prepared here is, market corrections typically, if you go back to 1980, market corrections on average happen about every 18 months. And the reality is, coming into 2022, we hadn't had a quote-unquote technical market correction since March of 2020. And we had this great period where, as you talked about, Dad, the only real periods of volatility we saw were last September and a little bit last January when the Capitol Hill riots occurred, but they were both pretty short-lived. When you look back historically from 1980 to 2021 through last year, not only did the markets average a correction about every 18 months, but the average decline of those corrections was 14%. So, you're looking at the markets right now. NASDAQ definitely has taken the bigger of the brunt of the pain so far, but it's also outperformed it, down 16 or 17, Dow and S&P down somewhere between 10 and 12%. I think that the reality is that there might be a little bit more room left here, but at least if we look historically at downturns and corrections, we do believe that the bulk of the pain is probably behind us. The other interesting fact, again, looking back historically at these downturns, again, from 1980 to 2021, the average total return in those years, to your point, Dad, at 70% of the time the market inside, the average return of the years where that downside happened was 13.6% by the end of the year. Right? Now, we don't have a crystal ball. We don't know that that's going to happen, but these historical standards are important. We start talking about interest rates, but I think this is a really big one, because I think even before the conflict between Russia and Ukraine, the other concern was the Federal Reserve raising interest rates, right? Yeah. And they said in December, hey, we're going to start raising interest rates. Powell said it in December. We're going to start raising interest rates next year, meaning 2022. So we had an assumption that was going to happen, but at the end of January and February, we started to see where the inflation numbers come out, and they were much higher than a lot of people expected. And the CPI, as I mentioned before, about 7.5% for 2021. Well, that got the markets under really heavy concern, because the polling went from maybe a 0.25% increase 3 or 4 times this year. And I have a report here, the CME Fed Watch, in February 24th, there was a 90% probability that we were going to see a 50 basis point increase in March, and there was about a 60% probability that we were going to see a full 1% increase in March, and that had the markets really, really concerned. What we heard out of Powell yesterday wasn't a range. He was very specific in saying that he would be supportive of a 25 basis point or a 0.25% increase in March. And what we saw yesterday is a pretty significant market rally. In fact, I think it was the second strongest day that we've seen in a couple of years, with the Dow up 500, 600, 700 points. So clearly, the other thing that the government, and the Federal Reserve is watching is the impact that's having here. And, I just want to take a second to talk about this, because I think Gene Goldman, the CIO of Cetera, made a comment to me last week, and he said, when you think about what's going to happen with oil, right, we know oil is going up, we know that the cost at the pump is going up, and that is inflation, right, by nature. That's a consumer product that's going to become more expensive, but it's also it has a deflationary component. And what I thought I would do just to think about this, so the Federal Reserve, which many of you know, one of the Federal Reserve's job is to try to control inflation. And how they control inflation is by increasing or decreasing the lending rate. So in March of 2020, the overnight lending rate, what they lend to banks at. In March of 2020, when COVID hit, they took interest rates to zero, right? And they did that to help avoid a major recession through COVID, right? And that took interest rates to zero, forced mortgage rates to go down. I mean, the low point was probably 7 months ago. You could get a 30-year fixed mortgage at 2.25%, 2.5%, and all these borrowing costs went down. And the general theory behind this is when borrowing costs goes down, that means consumers have to pay less interest, right? Which means they have more discretionary spending to spend on stuff, right? Well, now here we are. The economy has certainly fared better than most expected through the pandemic, and inflation is high for a lot of reasons. But the Federal Reserve doesn't directly control inflation. They don't flip a switch and force inflation up or down. Now, what the Federal Reserve does do, and the general theory here, is if they raise interest rates, that increases consumers' costs, right? If you're going to go buy a house or buy a car and your interest rate is higher, that means less money for you to spend on other goods, which will slow demand in other areas, right? And so what the Federal Reserve, I think, is partly looking at, and we don't know for sure, but, if we're all paying an extra dollar at the pump, right, that's inflation by nature because that's a consumer good that's costing us more, but it also has the same impact as interest rates going higher. Now, we don't know what's going to happen exactly with rates, as we get out of March. The meeting, was it next week after? We'll find out what the Fed does.
2 weeks.
2 weeks, but Powell was very direct in his comments yesterday saying he was in support of a 25 basis point increase. I also think it's important to understand that that's not going to be, the end, right? We're sitting at 0%. And rates are likely to continue to move forward. Touched on the ruble, the Russian currency is just getting hammered. Markets have been halted in Russia. And I guess just to make a point, we really didn't want to get into any specific investments tonight, but one of the things that our investment committee has been strongly in support of is our exposure to international securities or international investments for 3 years has been really low. I think most of our accounts might have 2 to 3% international investing. That's obviously helping us right now, and it's nice. Feels good to know that we don't have much exposure over there. And then the last kind of comment that I wanted to make as we all think about this, is we have a plan. We've been doing this for a long time. We have an amazing group of talented advisors. Our investment committee, as my dad mentioned, meets every Thursday and has a long our advisors and the people that are part of that committee have been in this world for a long time and monitoring investments. And we're not panicked right now. We don't like what's happening. It's hard to, be doing meetings and, obviously, looking back at the review we had maybe last year where we're at an all-time high and all of a sudden we're down off of those levels. But we are not panicked, and you shouldn't be either. It doesn't mean that we may not have to change our approach or react to things that happen because, this is changing daily. We're going to have to continue to keep our nose to the grindstone, so to speak, and make sure that we're making appropriate changes. But that's important. As I mentioned at the top of the call, I think if you're in one of those moments, if you're losing your sleep at night or just need reassurance or want to talk about the strategy, please reach out to your advisor. We are here to answer those questions. Our objective is to make good decisions and be smart through this. As I mentioned at the beginning of the call as well, I'm doing this for 21 years, and a lot of you out there have been investors on your own for a long period of time, and there's one common thing that's always occurred when we're on the other side of crisis, right? Whether it was COVID or 9/11 or 2008 and 9, after it's done and over, how often, Dad, do you hear, man, what an opportunity that might have been, right?
Yeah. Well, my father-in-law was a stockbroker for Merrill Lynch back in the good old days, and he had a saying that's absolutely the truth, and that is the majority of investors is always wrong. So when, you know, we definitely are not seeing extreme fear. I will say to you, I don't think I've had only maybe one call really from a client recently. I still see, contrary to what Trevor would have you believe, I'm in here a couple of days a week and enjoy meeting with clients, but the reality is that there will be a point in time, if this market continues with the volatility that we've seen recently, that there will be a point in time when we will say there's an opportunity here in certain sectors of the economy, and there is now, actually. We're waiting to see how this thing shakes out. But the reality is that in order to get a return on your money in this environment, there still has to be some risk that an investor has to take. And you know, still, even though interest rates are going to start to come up some, you can't leave your money in a bank or a money market account and expect to even offset the damage that inflation is doing to the value of your dollar. And so whether it's an income producing portfolio or a growth portfolio, we have some very good portfolios that pay very good income, and we have some that are sector oriented that you can make money in growth. But the reality is everything has risk, and our job is to try to make these investments on your behalf with as little volatility as we can and get you the highest rate of return. And we're still in that environment. We are not going to see real high interest rates just because of the amount of money that the government owes just to pay the interest on the debt. So we're going to continue to see historically low interest rates, and generally speaking, those lower rates are good for, you know, what we're doing here.
Well, thank you. I want to close by thanking all of you on the call tonight. We appreciate your continued support and friendship, and it's fun to see the list of names here, and many of you have been clients of the firm for 15, 20, 25 years, and we are very proud that you have continued to choose us and our advisors, and we are here to support you. If there's any questions or concerns you have, please reach out, and we look forward to seeing you at your upcoming reviews. I hope everybody has a safe and happy evening, and we look forward to seeing you soon. This will be the close of the call. Thank you very much, and we'll talk to you soon.